Risk tolerance is your ability and willingness to stomach a decline in the value of your investment. When you are trying to determine your risk tolerance, ask yourself how comfortable you will feel maintaining your positions when the stock market is experiencing large declines. There is an old Wall Street adage that say that you can eat well and you can sleep well. Eating well refers to the observation that uh, our long time horizons holding high risk assets allow investors to accumulate significant wealth. However, that comes at a price as stocks can be quite volatile, causing some investors to lose sleep. Why risk tolerance is so important? Your risk tolerance plays a crucial role in your gram playing for growing your money without stressing about it daily. if you don't if you don't have the stomach for dealing with the risk of losing your principal even temporarily, you will have to settle for lower risk investment and the lower returns that come with them. Investment have the potential for higher returns, often come with the higher potential for sudden downdraft or outright losses. With an understanding of your risk tolerance, you can create a strategy for your investment that will help you balance the worries of volatility with the potential for bigger result. So, how can you uh, risk tolerance works? Anyone can have a high risk tolerance when stocks are rising. However, the best timing to truly assess your risk tolerance is when the market is falling. Think back to the March 2020. The market tanked, unemployment numbers scored, the world conferred unpredicted level of uncertainty, wondering whether the COVID-19 would destroy the economy. What was your risk tolerance then? Did you hang on through those tough times? If you sold stocks during the panic, your risk tolerance was low. Or were you willing to invest more to take advantage of the market sell off? If so, your risk tolerance was high and it served you well as the stock market set recorded high in the 2001. Your risk tolerance may have been tested again in the 2022 as rising interest rates sent stock and bond tumbling. Some of the most speculating stocks fell more than 80% for their highs after investing reassessing companies' valuation and worried about their possible recessions. So, what are the types of the risk tolerance? Conservation risk tolerance. Uh, with this mindset, an investor is focused on the preservation of a capital and avoidance of a downside risk. That means lower returns, but the investor will settle for that in exchange of steering clear of any wild swing in the value. For example, a certified of a deposit is very conservative in investment. A bank or a credit card union will uh, guarantee a certain rate of a return exchange for keeping and investing money locked away from a predetermined period of a time. The promise of a return is a pro, but the low earning potential CDs historically can earn much lower rate of return than stock and real estate, which can be drawback. An older investor who is closer to retirement will likely to have fairly conservation risk tolerance. Moderate risk tolerance. To keep a foot into two camps, conservation and aggressive. Classical example include the traditional 16 by 40 equation. between the stock and bonds. These strike a balance between some money invested for growth while maintaining an eye on a stability for income generation at the same time. Aggressive risk tolerance. With an aggressive risk tolerance, the majority of the investor's portfolio is allocated toward riskier assets such as stock and real estate.